$1 million won't change your life. 3 earlier numbers will. Your money changes behavior at specific thresholds. Not at 1 million. At 10K, compounding wakes up. Most people miss this completely. At 100K, your money earns what most people make in a month. At 500K, your portfolio generates a full salary. Without you. The personal finance industry sold you the wrong finish line. Every book, every thumbnail, every listicle, same wrong number. You're optimizing for a goal that doesn't actually change anything. Here's what nobody tells you about wealth accumulation speed. The beginning is brutally slow. Most people quit here, doing everything right for years. Barely anything to show for it. That's not failure. That's exactly how the math works. 2 investors. Same salary. Wildly different outcomes in 15 years. One started at 25, one started at 35. Same contributions. The 10-year gap created a $400,000 difference. The difference wasn't talent, it wasn't salary, it was a decade. Most people are optimizing the wrong variable entirely. The milestone that matters first isn't the biggest. It's the smallest. $10,000. This is where everything begins. Not because of the money, because of what it proves about you. Invest $100 a month at 8%. 6.5 years. 7,800 of that is your money. 2,000 is free. At this point, people say, this compound interest thing isn't impressing me. That reaction is completely understandable and completely wrong. Stop contributing at 10,000. Never add another cent. Watch this. 6.5 more years. Interest alone adds $6,500. That's $1,000 a year you did not work for. At all. Wait 25 years total. That 10,000 is now 69,000. 59,000 of that is pure compounding. 0 additional effort. This is not theory. This is arithmetic. It always works this way. But 10,000 also does something the math can't capture. It removes the constant low-level financial anxiety most people carry daily. Most people are one bad month away from falling behind on bills. 10,000 covers 99% of life's financial emergencies. More importantly, you've proved to yourself you can stick to a plan. The mental barrier breaks. Now the only limit is time. Now, I'm about to show you what happens at 100,000. But first, I need to show you why the beginning feels broken. Think about a golf shot. You swing. You get instant feedback. Investing is the opposite. You act now. Results arrive years later. You have to understand the math before the math rewards you. This is a leap of faith unlike anything else in personal finance. Most quit when nothing seems to be happening. Don't be most people. The second milestone is where patience becomes profit. Let's go. $100,000. The momentum milestone. At a 10% return, $100,000 generates $10,000 a year. Without you touching it, now contrast that. $100 invested at 10% earns you $10 in a year. You could earn $10 doing almost any task. That's not powerful yet. Capital scales. The more you have, the more disproportionately powerful it becomes. Most people can't earn $10,000 easily in a single month. Your portfolio can. This is what it takes money to make money actually means, not gatekeeping, math. But here's the part that breaks people's expectations about wealth timelines. Invest $10,000 per year at 7%. Your first $100,000 takes 7.84 years. The second $100,000, 5.1 years. Same contributions, less time. Third $100,000, 3.78 years. The gap keeps compressing. From $900,000 to $1 million, 1.35 years. Same math. Each $100,000 takes less time than the one before it. Forever. This is what acceleration looks like. Meet Marcus. 35. Just hit 100,000. Feels behind? He isn't. Marcus compares himself to what he sees on social media. That's always the wrong benchmark. Here's what Marcus's 100,000 actually means if he stops today and never contributes again. At 8% over 30 years, Marcus's 100,000 becomes just over $1 million. His original money, $99,000. The rest, compounding. That's 90.1% of his final balance that came from doing nothing. This is the reversal. The effort required doesn't scale with the outcome. They diverge completely. Now let's talk about how to actually get to 100,000. Because the math is specific. Realistic target, hit 100,000 within 6 to 8 years. That's the actual benchmark. You need to invest roughly $833 per month at 7% to hit it. That sounds like a stretch. It isn't, especially if your employer matches contributions. US, your 401k employer match can double your effective monthly contribution instantly. $500 a month from you. 500 matched, you're already at 1,000 monthly. Compounding begins. UK, Canada, Australia, pension and superannuation employer contributions do the same thing. Check your benefits department. Free money waiting. Most people never claim it fully. Not maximizing your employer match is literally declining part of your own salary. The other lever is income. Harder to pull, but it moves the timeline dramatically. An extra $50 to $100 per week invested compounds faster than most people realize. A side hustle or freelance gig at the beginning of your journey changes your entire trajectory. In the early phases, contributions matter more than returns. Fuel beats engine efficiency. Later phases flip. Returns matter more than contributions. Same math, different chapter. This is where it gets really interesting. Stay with me for the next part, because the milestone I'm about to cover is the one almost nobody plans for. $500,000. Most people skip straight from 100K to talking about $1 million. That's the mistake. At $500,000 earning 8%, your portfolio generates $40,000 a year. $40,000 per year. That is a full-time salary in many parts of the world. You do not lift a finger, not a single hour of labor. The money earns it. Now here's the data point that reframes everything. The average U.S. retirement savings balance is $491,000. Source: Empower Personal Dashboard Data. That means $500,000 puts you ahead of average American retirees. Using a 4.7% safe withdrawal rate, $500,000 generates $23,500 per year. Combine that with average Social Security. A single person at 67 gets $48,352 a year. A household at 67 gets $73,204 per year. Both partners taking average benefit. Start Social Security at 70 instead of 67. Household income jumps past $85,000 annually. But here's what nobody is telling you. The real power of $500,000 isn't in retirement. It's in what $500,000 enables when you're 45, not 67. At 45, with $500,000 in investments, you have the option to quit your current job, not to stop working, but to take a lower-paying job you might actually enjoy. This is Coastfire. You stop feeding the portfolio and let it compound on its own from here. $500,000 at 45, 8% return, no further contributions. You hit $2.33 million by 65. Wait only 10 years from 500,000, you're already at $1 million. 20 years of untouched compounding does the rest. The portfolio does the heavy lifting because of its sheer size. You just have to not touch it. And here's the real reversal. 500,000 is freedom from needing to optimize everything. You could take 6 months to a year completely off and not materially damage your long-term outcome. That is the option milestone, not retirement, options. Now, what's the most overlooked reason people never reach 500,000? It isn't income, it isn't lack of knowledge, it's lifestyle inflation eating every raise. Every raise gets absorbed by a bigger apartment, a newer car, a longer vacation. Lifestyle inflation is the reason most people are perpetually behind. Salary doubles. Net worth barely moves. The path from 10,000 to 500,000 is 100% the same set of habits. Extended, there is no secret unlocked at 500K. I wish there were. It's just time and continued discipline. Marcus hits 500,000 at 53. He kept going after 100K. Nobody does that. What changed for Marcus? Nothing external. He just refused to let lifestyle inflation win. The data is clear. The math is settled. What comes next is the system you can actually deploy. Here is the complete system. 3 milestones. 3 different behaviors your money needs from you. Milestone 1. $10,000. Your only job here is to show up and not quit. The compounding at 10,000 is modest. You will be tempted to call it worthless. Resist. Automate your contributions from day 1. Remove the decision from your hands entirely. Behavioral economics confirms automation increases savings rates by 20 to 30% versus manual saving. The fund you choose at 10,000 matters less than the habit you build. Broad index fund, low fees. Done. Vanguard data. Over 30 years, a 0.03% expense ratio beats a 1% expense ratio by over $170,000 on a $200,000 portfolio. $170,000. Gone. Not to market volatility, to fees you didn't have to pay. At the 10,000 phase, your biggest enemy is boredom. The numbers feel irrelevant. They are not. Milestone 2, 100,000. Shift your energy from saving hard to investing efficiently. At 100K, your asset allocation starts to matter significantly. Diversification earns its keep. Morningstar research, portfolios with international diversification outperform single-country portfolios over most 20-year rolling windows. At 100,000, behavioral mistakes, panic selling, market timing cost you more than any fee. Fidelity's own data showed their best-performing accounts belonged to investors who had forgotten the accounts existed. Inactivity is a strategy. Specifically at the 100,000 phase, don't confuse motion with progress. Keep increasing contributions with every raise, every single one. Automate the increase too. Federal Reserve data. American households that automatically escalate contributions reach 100K about 18 months faster than those who don't. 18 months of additional compounding at this phase is worth years of returns later. Milestone 3, 500,000. Your job is now to protect momentum, not generate it. The worst thing you can do at 500K is make a large, emotionally driven financial decision. At this size, a 20% drawdown is $100,000. The stakes have scaled with the portfolio. This is why portfolio rebalancing matters more at 500K than at any earlier stage. A standard 3-fund portfolio, total U.S. market, international, bonds, handles this phase exceptionally well. Vanguard's 3-fund approach has delivered consistent real returns of 6 to 7% annually across multiple decades. At 500K, tax efficiency becomes a serious lever. Wrong account placement costs you thousands annually. IRS data, tax-advantaged account placement of high-growth assets versus taxable accounts can save $15,000 to $20,000 in tax drag over a decade. High-growth assets in tax-advantaged accounts. Bonds in taxable. This is the rule. It is not complicated. Stay with me. The next part covers the specific sequence most people get completely backwards. The correct wealth-building sequence. First employer match, then high-interest debt, then Roth or IRA, then taxable brokerage. Most people skip step 1 entirely. That's leaving a guaranteed 100% return on the table. No index fund, no ETF, no investment anywhere, gives you a guaranteed 100% return on day 1. After debt above 6% annual rate is cleared, contributions can compound fully unencumbered. Roth IRA, your money grows tax-free. At $500,000, the tax savings over a decade can exceed $40,000. $40,000 in tax savings, compounded for another 20 years, is nearly $200,000 in future value. This is the complete system applied. Discipline to 10K, momentum to 100K, options at 500K. The people who build real wealth don't know secrets. They follow a boring, consistent system for a long time. The BLS reports that median household income in America is roughly $80,000. 100K in investments is well within reach for most. Social Security Administration data. The average monthly benefit at 67 is $24,852 per year. That's your baseline income floor. Stack your portfolio income on top of that floor. At 500K, you are not just surviving retirement. You are above average. And if you take Social Security at 70 instead of 62, your annual benefit is 32% higher every year, forever. The system works, but only if you don't interrupt compounding at the moments it feels slowest. The slow zone is not a sign the system is broken. It is proof the system is working exactly as designed. Marcus is now 58. His $500,000 untouched for 5